going to talk about Netflix, which has sort of pioneered the streaming revolution. It produces content and owns the TV streaming service with over 100 million subscribers. They're expecting 115 million by the end of the year. It has a market cap of $84.4 billion, a PE ratio of 197, and doesn't pay a dividend. Wow, what a story Netflix has been. I think its return so far just this year has been 55% in dollars in the US. It's there, you can see the graph. It's been a massive success story. Can they continue?
When you look at a return graph, that is almost 45 degrees angle. That's massive. You know, you can almost think like nothing is gonna change. You know, you have to buy it, and there's no possibly better opportunity to buy than today, because you know it might not come down. You're looking at basically 197 times PE. You know, that's not really very expensive, obviously, if you compare it to the other P's, rated P's in the sector.
That's looking to half in about 2 years' time. So it's about 100 times PE forward, because they are growing earnings pretty quickly.
Certainly, and I think as you put it, you have 100 million subscribers. You're looking at going to 150 million subscribers. That's massive. It's almost like the whole of Nigeria being on their TV channel. So I believe it's a good business. As you said, market leaders, pioneers in terms of the streaming business. I would be very hot on it. If you look at, most of them are not really paying dividends. So Naspers dividend is almost zero, or 5 rand per 3,000 shares. They're not paying dividends because they're a growth story.
My only concern with Netflix is, okay, we've spoken about Amazon. They've got almost unlimited cash. Apple have just jumped on board with this whole content production business, bringing Steven Spielberg on board. We know how much cash they've got. So Netflix have earmarked about $7 billion to content production over the next year, which is a lot of money for them, because annually they're making about $12 billion in revenue. They're definitely doing the right thing by pushing original content and not focusing on short-term profits. That's correct. But the competition for original content is going to continue to increase. So they're going to have to continue to be putting big bucks into original content. So what was originally an aggregator and a low capital intensive streaming business is now becoming pretty capital intensive.
Well, it is, because of the competition and the rapid nature of the changing technology and consumer demand, because people are just demanding new things every day. Because remember, I mean, we just consumers every second. They have to. So if you're looking at 7 billion spent, and you have a total revenue of about 12 billion, so it's almost 55–60% of that you plowing it back into developmental spend. I don't believe that there's anything wrong with that. So if you look at in terms of Naspers, you know, they're still giving you a little bit of negative cash flows, but certainly we're buying into the future. We're buying into the story and the future cash flows. Competition, I think they're not going to be able to run away from it, given the fact that, as you say, Amazon and some of the guys are far much better, and certainly they have got a bigger brand.
I think also what's blown investors away is that growth in subscribers, especially internationally. I don't think they realized how big the adoption would be outside of the US. So Netflix, hot or not?
I'll be hot on Netflix,
Cool. I'm going to agree with you. I think the subscriber base is still pretty small. They can get up to 1 billion subscribers in the next 5 years. So we're going to be hot on Netflix. Last up, Time Warner, which is a cable TV and cinema company. It is in merger talks with AT&T. It has a market cap of $78.9 billion, a PE ratio of 18.75, and a dividend yield of 1.59%.